is life. Hey, what is happening? Welcome back. My name is Maxim Cruz, and today we are gonna be talking about class life. Again, that's just a disclaimer. This is for informational purposes only. Make sure you check out with the right tax or professionals in order to get this information correctly. I am a licensed real estate broker as well as a real estate investor. And today we are talking about class life. In 2019, the only publication that I'm going to reference, and again, make sure you check with your tax professional to make sure that this applies in your scenario, because I don't know your scenario, but is the IRS 2017 publication 946. I'm not sure if they had another one last year, but this is the one I'm referring to. This is the one my wife, as a tax planner, has talked to me about, so this is the one that I understand. There's a bunch of things that the IRS quantifies as class life. Obviously, it's any sort of property, and again, make sure you check with your tax professional, but it's any sort of real property, whether it's furniture, whether it's a vehicle, whatever you're using for business purposes, that is identified, or whatever is identified by the IRS. So, for example, in a residential rental, we deal a lot with investors and we look at real estate. So we have two types that we mainly focus on. There is a third type, which is kind of interesting, which until I moved to Florida, I didn't know about, is kind of the Native American property and how these things are quantified a little bit differently. If you want more info about that, definitely contact your tax professional. If you're looking at buying into property or investing into something that has that Native American standard, or that has that class as identified by the IRS, you might have some advantages there. But for other purposes, overall, when we look at residential rental facilities, so if you're looking at multi-family units, things that have more than, I think it's 80% of it has to be for rental purposes. So you have a 27.5% what's called cost recovery. Non-residential real estate, so this is everything else, certain warehouses, hospitals, office buildings, things of that nature, just something that's not non-residential. It's not being occupied, people that are living there. You have a 39-year recovery period. Now, why does this matter? The biggest reason that this matters is, again, when you are considering into investing into real estate, these numbers are going to make a huge difference for you. Again, when we look at them, 27 and a half years versus 39 is a large number. So let's go back to that $1 million example. Let's say you bought a $1 million multifamily housing. If you took that $1 million and divided by 27.5, you have $36,363. Now let's say you bought the same $1 million property, but now you bought an office building and you divide that by 39, you have $25,641. The difference between those two is not much, $10,721.97. So as you see, the difference between these two numbers, which are your annual cost recovery, is $10,721. What does this mean to you? Again, make sure you check with your tax professional to make sure that this applies in your scenario, and make sure you get, a financial advisor that can further, tell you more if this is the correct approach or not. As a licensed real estate broker, I superficially understand this information and I am sharing with you for you to consider it, but in no shape, way, or form is this a suggestion on how you should file your taxes or consider it into an investment. So going back into that $1 million property, this number right here, let's say that $1 million was a residential multifamily rental, every year, because you're depreciating that property, you can take a tax deduction of $36,363. You're claiming that as depreciation. If this was an office building, it would only be $25,641. So again, how does this affect? Going back to our 16 core elements, and if you haven't seen my other video, make sure you go and check them out. I talk into each one of these differently and specifically into what each one of them has to do. So here, when we're looking at, for example, tax brackets and tax benefits, you have on a $1 million property, you have $10,721.97 of tax benefit buying a multifamily, versus if you're buying an office, that tax deduction that you are taking here, you don't get here. Now, make sure you understand what depreciation does to your base when it comes to capital gains. So that's a whole other video, and again, I might not even get into that because that is a very gray area where I think the tax professionals are in a better position, or a financial planner is in a better position to explain to you how depreciation works at the time of sale and what you need to consider as far as capital gains tax when you do that. But again, just look at it here. When you're considering the class life, when you have residential versus non-residential, and you have these 12-year difference, on the $1 million property, you're talking about $10,000. So understanding what class life of building you're buying, is gonna give you an understanding of your scenario as far as your investment scenario. So then let's go back and look into our 16 core elements and see how class life is affected. Obviously, location and size. If you're buying residential versus non-residential, you need to know the location and the size of the building. The income, yes, we're actually considering class life. How could that do to the income? Why? Because this number right here, for tax purposes, when they do the taxes at the end of the year, obviously if you had higher income and you're able to claim higher depreciation because of your class life, so income is considered. Appreciation, I don't think is considered that much. Again, maybe as a side note, when you're buying into multifamily, or you're buying an office building or a hospital or something like that, maybe you ask your realtor, hey, what's the appreciation for this area? So if you haven't checked out that video, I did a video about appreciation. Expenses, I guess if you're considering income, you're considering expenses. The price, yes, because for tax purposes, that becomes your basis. And again, check with your tax professional. I don't want to be taking this the wrong way. So I'm a real estate broker. These are things that we understand superficially. These are things that we observe, but we are not financial planners and we are not tax advisors. So, as far as to give you tax advice, make sure you check on how that price is affecting yours. So leverage, I don't think this is considering leverage much. Financing term, probably not. Principal reduction, definitely not. Tax benefit, definitely. You obviously see the difference as far as the timelines. The tax bracket, probably not, because you're only looking at the class life, so that doesn't really relate to what you're doing. Rent increases, I guess if you're considering income and expenses, there's some validity there. Other tax incentives, probably not, because we are very specific at looking at class life. Closing cost, I guess that ties into the price. Capital gains tax, make sure you check with your tax accountant or your tax professional, tax planner, financial advisor. Capital gains tax is definitely affected on this one. And your risk, obviously, you gotta know if you're buying a multifamily, what that risk is, versus if you're buying a non-residential, an office building, a hotel, whatever that is. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 out of 16, just by considering the class life. So again, when you're looking into investing into real estate, just by thinking, hey, should I go in and buy residential, or should I go in and buy non-residential real estate? We're talking about real estate here. How does class life affect this? So hopefully this has helped you out. Hopefully understanding the class life is gonna allow you to maybe adjust your portfolio, or maybe plan out your portfolio and say, hey, 75% of my portfolio is going to consist of residential real estate and 25 is going to be non-residential real estate, or vice versa. Maybe 100% of it is non-residential real estate, because you're a large group and your holding period or whatever the case, it's better for you to have the non-residential case. So each case might be different. Hopefully you've understood how class life can affect mainly your depreciation. If you have any questions, if you want me to cover any specific topics, make sure to reach out. Have an awesome day.